Hello everybody, it's Argentus Maximus, or Norman Green, from the Argentus Maximus blog, and I've got on the other end of the line here Bron Suchecki, the Head of Research and Analysis at the Perth Mint from Australia. Hello Bron.
How you going?
Hello. The Perth Mint, have they got a website we can check up on, and also can you tell us about your own blog please?
Yeah, Perth Mint is just perthmint.com.au, and I blog personally under goldchat.blogspot.com. Look, the blog, I do blog on that relatively frequently. I'll try and get a bit more frequent, but at least every week, and I'll be trying to do something every couple of days on there. And it's a mix. I usually put it down to record stuff. If I went into a particularly long dialogue on a forum on a topic that's of interest, then I'll just sort of put it onto the blog so that I've got a record of it. But I do just write on topics, whatever's going on in the gold market that takes my interest. I started the personal blog because the Perth Mint wasn't comfortable doing any social media in 2008 when I started. So I just said, look, I feel like I need I want to say something and talk. Now, I suppose they could have stopped me, but to the credit, the CEO said, look, that's your personal life. You can make your own personal comments. I'm not going to stop you from saying that. But, and look, I think subsequent to that, after a few years, the Mint's moved along and social media's become more accepted. So, they're starting to do a lot more of that. But that's still a personal sort of view. So I feel a bit more free there to write something out of my own opinion that probably, you wouldn't put on a corporate blog.
Where can people find your output, your research, Bron? Is it for bespoke clients or private for Perth Mint, or can we avail it on the Perth Mint's own website?
It's mostly internal. That's where my role's been predominantly in the past. So it's pretty much internal analysis, both financial as well as just strategic of what's going on in the industry and what's happening in the industry. So, but we're going to be getting a new website in hopefully about 6 months' time, and that'll give us a bit more functionality around social media and content. So I'll start to write a bit more content for the website officially.
I'd like to discuss gold as Forex, gold as a foreign currency for the moment, rather than as the commodity it's normally regarded at. Most people think of gold as just an ordinary commodity, but I have found it very interesting to consider it as a Forex, another currency, which takes us into interest rates and also competing bond rates for other currencies. And of course the rates for gold would be represented by backwardation, contango or GOFO. So can we discuss that for a little while, Bron?
Oh, look, certainly I think, just because gold's physical, people do tend to ascribe that sort of commodity view of it, and they talk about gold being monetary, but they don't really run to the full implication of what that means to say it's monetary. And I think if you look at gold in terms of all of its characteristics, the amount of stock that is available above ground compared to the amount of annual production that gets put out, it does not relate anywhere near to a commodity. So I think, analysing futures markets purely from a sort of commodity interpretation in terms of what the gold market's doing is wrong. I think you have to look at it as a currency. Central banks hold it. They hold a large amount of it. You can't ignore that. It trades on FX platforms. And yeah, there's this huge paper and derivative market and leveraged, speculation in it. And it has a huge turnover if you look at the LBMA statistics. So it's clearly in all those aspects very much like a currency and trades on an FX type basis. So I would agree with that completely.
So if we look at that particular point of view of gold, gold as Forex, then we need to pay attention to bond interest rate spreads between currencies as affecting gold, and versus that we would place the holding costs of the gold. Now the holding cost could generate income in terms of leased gold generating return, but this is necessary. So if we don't generate lease or income from gold, then gold would become a de facto zero coupon bond. So what about the rate spreads and holding costs and bond yields as factors in the valuation of gold?
Yeah, no, I think it's a valid point. Look, I think it's difficult because I don't think it gets a lot of coverage because the concepts of backwardation, contango, and then also currency carry trades is very difficult for a lot of investors to understand, and it's a difficult concept for analysts and commentators to explain. So I think it gets left out by a lot of people, and again, they just look at that from a commodity point of view, from a physical point of view. And so even a lot of this sort of analysis around the basis and backwardation and contango, they don't look at that from the point of view that gold is a currency with a lease rate or an interest rate, and therefore, the trading that goes on with it is always an analysis of gold in the context of that FX review of, well, this exchange rate versus that exchange rate versus the two different interest rates on that exchange rate, exactly. The risk that rates will go up or down. Okay, I'll sell this currency and buy that currency, and this currency has a higher interest rate, but the currency could decline. Here's the interest rate covering me for that risk, and how long you're going to play that trade. Those things, I suppose, are very foreign to, the coin investor who's got a physical coin in front of them and not so comfortable with that virtual market. And I think as well, I mean, if you look at, just to throw it in, if you look at a basis trade on futures markets to spot, it's really just a borrowing and lending transaction.
This is the holding cost trade-off. So if a trader buys the spot and sells a future, or sells a spot and buys a future, for the time difference, it's an income generation like forward contracts, essentially playing the gold yield curve as a carry trade. Correct?
Yes, and that transaction, they are effectively providing liquidity or lending gold or borrowing gold out of the market, and thereby directly affecting the lease rate. Now, people just look at the futures price, compare it to the spot price, and see this move, but don't realise that when you actually buy spot and sell a future, or the reverse, that what you're doing is really, I've got gold, I'm now selling it to you, effectively supplying that liquidity into the market, which to a bullion bank, when they look at a futures and spot spread, to them that's part of a forward rate market, and they look at that back down to an interest rate on gold or the lease rate, and then they've got that liquidity and they can use that. And to them, I've said they're sort of like flies in a web, where they're sitting in the centre of the web, and there's all these markets on the outside. You've got physical markets in Asia, you've got all these different physical markets, you've got futures markets around the world, you've got all these spot markets trading, and to them, they're arbitraging every single one of those things off against each other continuously. That's what their desk does. And to them, that is purely a financial instrument, and its lease rate or interest rate is one of those factors that goes into the calculation. And they're just arbitraging the demand and supply that comes out of all those different markets.
I think in the internet blogosphere, this isn't talked about enough. Let's say we're in a bear market, and let's say the gold is in backwardation. And gold is in backwardation probably because it has been leased a little bit cheaply into the markets by the central banks, which changes the yield curve. What they're doing essentially is they're depressing it. It's a little bit like QE or Operation Twist on gold, where essentially they're pushing down short-term rates on gold, and they're allowing long-term rates to come down a little bit, but possibly only half as much as the short-term rates. So let us call gold leasing by central banks at favourable rates. Let us call that an Operation Twist in gold. Would you agree with that characterisation of what's going on?
Well, I think you have to, because, what do central banks hold? They hold a whole heap of currencies, and they hold gold, and their express, objective is to manage their interest rate and to manage their exchange rate. And so they'll use any of those assets as a tool to achieve that sort of end. Now, you can take a sort of conspiratorial angle where you say they're purposively saying, right, I don't like what gold's doing, so I'm going to do X, Y, and Z. Or you can just look at it purely from the point of view where I think a number of central banks just have, modern portfolio theory type of view of stuff, and saying, I've got all these assets and I'm trying to manage that. And so they look at what lease rates are doing and say, yes, that's attractive or not, and so I will lease into the market or not. So it's hard to know what that behaviour is. I mean, I just look at the Reserve Bank of Australia. They were lending out almost all of their 80 tonnes, but they're now only lending out 1 tonne. And, ways that...
how much and why will never really be answered.
No, but I think if you look at that example, they, in their annual reports, unlike any very few central banks, they report not just how much ounces they have physically and how much they're leasing, but they also report how much they've leased by maturity. So they break it down by 1 month, 6 months, 9 months, 12 months, and they break it down by the credit rating of the counterparty they've lent it to.
Well, that is a
And if
very
you
interesting point, because with the falling credit ratings of certain large banking players, central banks are going to have to take or their compliance departments are going to take a different view on leasing at certain prices. So once again, there is a feedback mechanism which is going to kick in here, which is as the leasors, I suppose they're lessees, aren't they? The bullion banks taking the gold would be lessees, wouldn't they? As their credit rating declines, even if it's only slightly at the moment, then this has implications for leasing rates and or the risk of such lending by the central banks. And we may assume that in the background their compliance departments are having pretty hard conversations with the people in charge of getting a return out of that gold portfolio.
Now, that's true. And if you look at the RBA's figures, you'll see that their lease book, it got a lot of exposure to lower rated, and then they've wound that whole thing back. So it's pretty clear to me from at least their behaviour that they didn't see the risk-return trade-off with the sort of ratings that they had to who they had to lend it to and what the lease rate was actually satisfactory. So they just pulled all their leasing back. But now, I'm not saying that's what every central bank does. Other central banks may have geopolitical and, different sort of motivations, but it's just an example.
It's related to that. And when gold moves from backwardation to contango, it has not done that yet, but historically we see it swing from one to the other. In agricultural commodities, the softs, we find that softs swing from backwardation to contango as the harvests come in and supply and demand fluctuates. Or as the harvests don't come in, or frosts come and go by. The feedback from that is basically a short-term one usually. Now I propose that gold, being currency related, must be considered more as a zero coupon bond than a soft commodity. Not completely, because it's not 100%, but to a large degree it is. And so I put it to you that the swings in backwardation and contango of gold should be expected to be more long-term swings, in the sense that bonds tend to produce long cycles. Now, forget the 20 or 30 year bond cycle. Let's just consider the 3.5 to 4.5 year business cycle, interest rate swings, which are far more common. I think we're actually moving down in one of those swings at the moment. Do you have any thoughts on this?
Well, look, I think it's a bit hard without a chart, but you need to pull up a chart of GOFO, the forward rate, as well as the lease rate, and then also the federal funds rate. And what you will find is that when that federal funds rate is so low, then you can easily find gold swing, because the lease rate is also low itself. It can easily start to swing in and out of backwardation very quickly. And so, look, my view on the backwardation is quite minor. I know people made a big sort of deal about it, but some of the backwardations we're talking about, 20 basis points or something, and those are effectively what you would say would maybe be your gross profit, and there's no calculation of the actual transaction costs of taking advantage of that. The costs of maybe physically having to get the gold and move it around and settle it into COMEX if need be. So I look at a lot of that. I think when the federal funds rate is this low and the lease rate has been, sub 50 basis points for a long time with minus de-hedging, I think there's a lot of noise in the so-called backwardation or even small contango. It needs to be more than 50 basis points, I think, for it being meaningful, particularly if you look at 20 or 30 basis points and work it out as a dollar amount, and and then some of these backwardations that are talked about are sort of like 30 days, and for 10 basis points or something, you go, well, wait a minute, the total profit on that is the bullion bank. If you look at it from a bullion bank trader's point of view, he's sitting there and going, yeah, there's backwardation or it's contango, right? What is that? That's like $1 profit. So if I do a whole ton of gold, which is $50 million, I'm going to make $32,000. Then I've got to take off the costs of, maybe the warehouse to move it around and settlements to settle the trade. But, they've got limited capital, right, and they're going to deploy it into a trade that makes real money. And so, they're managing to say, what are you doing wasting your time trading that, that supposed arbitrage?
And there you bring in a very interesting point. You've mentioned in passing that the costs of the commodity side of gold, the physical costs incurred, looking at the cost of gold, We have on one side the Forex side, or the qualities of gold, the zero coupon bond qualities, things underestimated in the blogosphere as factors, I think. But on the other side of this is the physical bullion qualities, or the commodity features of gold, warehousing costs, which act as a drag on gold as a pure currency. People regard gold as a pure currency. Well, it is if you've got it somewhere safe, which has costs. Let's look at some of these physical things: warehousing, refining, and so on. Refining is a separate business, and the Perth Mint in particular. Refining has had, or it's still having, a good patch. The refiner stocks are all nice upward staircases at the moment, if I only knowed enough of them. I see no top on that yet, by the way. And this puts us in contrast to the price of the metal itself for the refiners, and the metal itself has declined significantly in the same period. So Perth Mint and hedging and minor suppliers and Perth Mint's Asian trade, can we talk about this side of the business?
Yeah, sure. Well, look, I'd just say on refining, one thing that's not appreciated is that refining is actually a global business, and it's highly competitive, and there is massive overcapacity in the industry for the amount of gold that needs to be refined versus the capacity of the industry. And it's not overly difficult for refiners to add cells in to increase capacity. So it is really a pretty crappy business, and if we were just a refiner, I don't think we would be really in the business at all. For us, the money comes more from not so much from the refining, but from the processing and trying to value add to the gold. To make coins, to make bars, to try and sell it. The refining itself is pretty much a really crappy sort of business. I mean,
I wouldn't have expected that. No, that thing comes as a surprise. But I suppose the refining side is getting a bit of a fillip or a boost in volumes due to the recasting of imperial LBMA type bars into metric bars desired by Asia. Would that represent a temporary boost for the refining business then?
Look, it is a bit temporary. It is quite volatile. Look, you've got this base. Mines produce gold continuously; they don't stop. So their output is continuous. What is the swing factor for the industry is really the scrap flows, and in this case, also you're talking about rebarring, say, from ETF metal that's going into kilo bars. But that stuff is dependent on demand, and it surges and changes. The price goes up, and scrap goes up. The price is down. Scrap volumes drop off. So that part of it is quite a competitive part of the business. But no, I mean, just to give you an example, to refine gold is probably about a week or a 2-week process to tie up the metal. I mean, once you get the doré, you run it through the chlorine process, then electrolytic process, and then you fabricate it into a coin or to a bar, and then get ready to distribute it. You're talking about a week to 2 weeks. Yet mining companies, the industry is so competitive now that mining companies want their gold effectively 2 days after handing it to you, if not earlier. And this creates a massive funding issue. So the biggest cost item for refiners is actually the funding. And that means them borrowing gold to fund effectively that they've got to pay the gold out to the miner here on day 2, and they don't really get a sale or process of that gold until 2 weeks later. And so you can imagine that you've got a lot of metal that gets tied up in the business, and that's a significant cost for the industry. So with lease rates being low, the costs are low, but once lease rates go up, the profitability of the refining industry really is quite hampered significantly. So
that's interesting, as I hadn't considered it. Refining is a high-cost inventory, and capital adequacy has its own problems. Do you want to divert into Perth Mint's policies for handling inventory? We weren't going to. Could you give a few minutes on about the dates and the title of the bars and allocated and unallocated and so on?
Look, it is relevant because you talk about leasing, and people often stick at leasing and think, well, leasing's evil because you lend metal to people and they sell it, and they're short selling and pushing the price down. But there is actually a huge industry, like mints and jewellers and refiners who have a lot of gold tied up in their business. That's their working inventory, their goods. So that has to be funded in one way or the other, and ultimately that's what drives a base demand for leasing of gold. In our case, yes, we did used to lease gold from bullion banks, but the depository business that we created really was an attempt to effectively cut the bullion banks out, because in a sense the unallocated clients, when a client buys unallocated gold from us, what they're really buying is part of our physical inventory, the gold that's sitting around in semi-fabricated form. So in a sense they are really saying, look, you know, you can have my gold, you can use it, and in that sense they're effectively funding the business for us. So it's quite significant in giving us some security, and eliminates the interest rate exposure, lease rate exposure that we would have had otherwise.
Let's deal with this one here and get specific on it. You have at the pertinent allocated and unallocated customer gold in stock. Now the allocated, I get, it's audited and it's numbered and it's stored separately. The unallocated, Bron, you can confirm this about the treatment of the unallocated gold at pertinent. What's the policy regarding gold in and gold out, and the maintenance of quantities? Because the fear, of course, out there is that at some time in the future unallocated gold will turn out not to be there.
Yeah.
So yeah, for clarification, the Pertsmint's policies on allocated and unallocated, what's it, first in, first out, last in, last out? How do they manage the unallocated pile of inventory?
Well, the unallocated, we have a pretty straightforward, and it's on our website and been there for a long time. The unallocated is used purely to fund the business and our operations. We don't lend the metal out. We're not a bank. So it's difficult. I mean, it's unfortunate that we use the word unallocated, because many years ago in the early 90s, you know, that didn't have its connotations and with it, but now it subsequently has. And certainly unallocated with a bullion bank is at risk, because they are lending it out to other people and you're taking exposure to the adequacy of their lending book. In our case, that metal is used totally within the business. So if you look at our balance sheet, and we actually employ a metals accountant whose job's purely to run a ledger, a general ledger in ounces of gold and ounces of silver. And we do that because we're constantly trying to make sure that the liabilities that we have to our unallocated clients, let's say we owe them, you know, 1,000 ounces of gold, that we have 1,000 ounces of physical gold in the business. And his job is to basically debit and credit and make sure that we run a square book in that sense. And so, yeah, I mean, people don't sort of understand that. And, you know, I do say to people, if you don't understand it, then don't buy, just buy allocated. But we have a lot of clients that do, and about 85% of our clients hold unallocated, because they understand that they're getting a gold-backed product. Yes, it's backed by work in progress. So, you know, there is a risk, and there is a difference between it and allocated, in that if you turn up to the mint and say, I want my allocated coins or bars, we just go into the vault and pull them out. If unallocated clients turn up, we say, and let's say all of them turned up at the same time on the door.
Well,
and said, we want
the question, of course,
yeah. Yeah, well, we would say, fine. It is really a first person turns up, they would start to get it. But at some point, we would have to say, look, these coin minting machines can only stamp coins out at a certain rate. We have to get all the gold up from within the mint and turn it into fabricated coins. So there will be a delay until we can effectively fabricate all the gold in the business and hand it over.
So to clarify, can I just hypothesize and rephrase what you're saying, is that of your unallocated customers, customer A, B, C, and D up to customer K may have bars and gold sitting in Perth Mint inventory against their liability or their asset, but which Perth's liability. But customer LMNOP may be looking at stuff which has been refined and not cast, and may have a delivery time for it to pass through your processing facility. And customer R to customer Z might be actually, they've got doré bars, they got stuff that just come in today off the train or whatever. It's sitting over in the corner, and you know there's an awful lot of stuff to be done with it. Sort of come back in 2 weeks maybe, because it ain't ready yet. Would that be a fair characterization of the assets backing the unallocated clients?
Yes, absolutely. I mean, not that we say that this client owns this part of the metal. You know, that's the point of unallocated, is that it's a pool. So we don't say that client A has the bars and client Z has doré backing their account. It's just 1,000 ounces owed to clients. We have 1,000 ounces of physical. But yes, that physical is in the form of doré, then sitting in electrolytic circuits, then sitting as 400-ounce bars, and then sitting as gold strip, and then some of it's blanks, and then some of it's finished coins. And so it's in constant flux and turnover, because as we sell coins, we're then buying doré and effectively maintaining the same amount of gold. But yes, the form is always spread across a whole heap of different things. And we're quite explicit about that to clients. And that's the trade-off. If you want free storage where you're not having any holding cost, and clients who bought gold, and I've got clients that, you know, I opened accounts for in 1997, you know, they've had free storage, which adds up quite significantly over time. For all this period of time, you take that benefit with the slight risk that if everyone came in at the same time, then yes, there's going to be a case of, you know, a couple of weeks or months for us to get all that gold and melt it down and make it into coins. But most clients consider the risk that everyone's going to want to take delivery instantaneously is extremely small, and that, you know, if there's a normal rate of collection, that our normal production capacity can meet that. So we think there's a pretty low risk of really not getting your physical. But you've got the comfort of knowing that we're a mint, so we have the capacity to do the transformation and get it to you. It's not like, you know, we're having to go to a coin dealer or a mint to find the gold to give to you. We're actually manufacturers of it, so the risk is quite low in that sense.
And one last point before we move off that, the hardcore precious metal heads, you know, the people who say it ain't yours unless you've got it, and all of that.
Yeah.
In the event that gold, for various reasons, becomes scarce, and that's a characteristic of gold, which occurs maybe once every decade or two, and as a result of becoming scarce, it also becomes quite costly suddenly. Bron, in those circumstances, does Perth Mint take steps to ensure that the gold which is in-house would always be sufficient to cover unallocated clients, or would it be the case that the new gold must be acquired? Do the auditors in charge ensure that sales going out the door are matched by unprocessed gold coming in? What can you tell us about asset portfolio management by Perth Mint?
Well, we have a full treasury department, but they're not a risk. Most treasuries are risk takers and traders, whereas we have dealers. So our treasury is actually a risk minimising. We set it up to minimise the risk, and the way that they operate is every time a sale goes through any of our computer systems, it's automatically pushed into our treasury system, creates a position saying you're long or short. In most cases, we're short because we're selling products all the time, and they instantly are going out and covering that and buying. So we're always, and that's effectively every single day we square that book off, and we probably wouldn't run a position any more than a couple of 100 ounces long or short at the end of any day. So we are constantly square, always making sure that we've got the replacement. So in the scenario that you're describing where, say, the gold price goes absolutely nuts and no one wants to sell and everyone's sitting on it and the price just goes sky high, if we are unable, if our dealers are unable to acquire gold either from mining companies, no one wants to sell it, or bullion banks, then we can't sell, even if we've got gold sitting in the factory. So we might have a whole heap of coins sitting around ready to go, but if we can't cover ourselves and cover that exposure and buy the physical gold to replace that, then we just stop the operations. We can't really sell. And we would sit there with the 1,000 ounces of gold physically, backing the client's liability and going, right, well, we'd like to sell product, but we can't until we actually can find the replacement to buy it with. Because to us, to run the inventory down, it does no good, because we're a flow business. We need to buy the replacement so that we can continue to make coins and make money out of continually making coins.
I think you answered that. Thanks very much. I appreciate it. Let's talk about the precious metals and their location and Perth Mint's location close to Asia. There's a lot of conversation about Chinese purchases of gold, difficulty of getting trade statistics and so on. Can I discuss with you Asian mine purchases, the new exchanges, the changes of title to warehouses within the bullion business? I mean the flow of gold towards Asia now, the infrastructure which is in place, the Shanghai and Hong Kong exchanges. Let's start with the mines. Have there been many Asian purchases of Aussie mines, Bron?
There's been a little bit of it. I think it's. I don't think there's actually a huge torrent of it. I think they probably find a more sympathetic regulatory environment in Africa, and I think that's where the focus is. I think there's been a few purchases of some smaller mines in Australia, but at this stage, it's not really turning into a flood yet.
Let's consider the other non-Chinese Asian nations. Bron, India is obviously huge, but it has legislation now to reduce imports of gold. But other populations nearby are huge too. Indonesia, Malaysia. What's going on there?
Traditionally, India is really our main target market in the past. That really has completely dried up, obviously with the restrictions that their government's put in place. But, what we find is surprisingly that, interest out of Thailand and surrounding areas suddenly picks up and we seem to be putting a bit more volume through there. So I think, the gold will still get into those countries. I do think people do overlook places like Vietnam. There's a significant gold market there. The numbers going into those countries are also reasonably high. I mean, obviously China's the large one now, but there's still quite a bit of physical that goes through all of those countries in that region. So I do think people forget about that. But certainly China has become incredibly dominant for us, and a significant amount of all the sort of kilobars that we ship are really going through into Hong Kong and China. So they really have sort of stepped up and taken up the slack that India has. And if India does drop its restrictions, boy, it'll be interesting to see a tussle between the importers in China versus the importers in India trying to get hold of physical.
I think Western banks and governments have made big efforts to reduce that competition to buy. But let's look at the new exchanges, Shanghai and Hong Kong and the Middle East. Koos Janssen of In Gold We Trust has produced wonderful information about the flowage of gold from west to east. Can you talk to us about Shanghai and Dubai?
We do think that there's a bit of a tussle really in that region now, where they are trying to sort of become dominant. So I think Singapore and Shanghai, Hong Kong are really starting to have a bit of a fight. Singapore is really making a big play to become a gold centre, dropping the GST on gold. The Singapore Freeport, they're looking to help Metalor open a refinery there. So, there certainly is quite a bit of movement in that region, and I think that's all positive, and it just shows that Asian market's starting to develop and become a bit more sophisticated. I think China's got a long way to go. There's a lot more to do in the liberalisation of the yuan, and as well as a whole lot of other sort of market infrastructure that they need, interbank markets and trading. So I think we can look at Shanghai Gold Exchange and go, wow, but there's so much more that they need to do. And at the moment, I think people also ignore there's really only, I think, about 9 licensed importers. You still need a license to import gold into China. It's not a free market, and you also need to apply for quotas to import. So sometimes, I don't know if you remember, some months ago there was a huge premium into China. A lot of that actually had to do with the fact that some of those, you got a limited number of importers, and some of them actually ran out of their quota. Now, the quota isn't sort of fixed, so they can reapply. But, being a semi-bureaucratic, centralised situation, they had to apply for a quota, so there would have been a bit of a delay. And there's not that they weren't going to get approved, but just for the paperwork to go through, adds a week delay, let's say. That's enough to result in sort of physical shortages within China, resulting in a huge premium. So there's still a long way for them to go in terms of opening up that market in terms of the number, and they are talking about opening up the number of licenses. So I think that market's only going to grow and become a lot more liquid into the future. So as I said, I think India is going to have to give up on their restrictions at some point, and when they do, it's going to be quite an interesting fight for the physical from those two countries, and we could start to see some action there.
Can we change topic to the aspect of gold as an investment class now? A result of quantitative easing or money printing has been the undervaluation of risk, in my opinion, and as a result, the main result is that money has flowed away from gold and into stocks. Now, capital going into stocks is also a statement of investor sentiment about expected inflation, and therefore at some point the inverse correlation between stocks and gold could switch to a positive correlation, and that hinges upon the market's answer to the question: is gold money today? If so, then gold competes with bonds and correlates with bonds. Or is gold an inflation protection asset today, in which case gold is competing with stocks, and it might be a better inflation asset than stocks, but it would correlate with the stock market. And I track historical correlations of gold to other assets, and I found that it moves in phases and it flicks from one to another.
Yeah.
So gold might be tracking stocks up to a certain point in time, and then suddenly it's tracking bonds or something else instead. Now, in shorthand, I suppose what I'm saying can be summed up by the phrase risk on, risk off. Now, looking at risk on and risk off in the medium to long term rather than the short term that's normally reported on, where do you think that the attitude or sentiment is going to go in relation to gold as an inflation hedge before stocks, or versus gold as a safety asset beside bonds?
I think you're right to sort of pitch it in terms of the general narrative. I mean, gold's very much a total sentiment asset, not so much a fundamentals asset. I don't mean that to disparage it, but that's what monetary nature means. And so it is very much about the narrative and what the hedge funds and the large players are thinking and their attitude to it and what they think is the current trade. So yes, gold was a trade, and they were playing that trade, and now the view is whether they believe it completely. And I've seen some bloggers saying that they talk to fund managers and they go, look, we don't believe this stock market, we think it's overvalued, but that's where the trend is, and that's what we've got to be in there. So there's a bit of cynicism, but at the moment the view is that the US is recovering, and things will be okay, and so the money flow and the weight of money is moving into the stocks, and it's out of gold. And I suppose the run up to $1,900, I think what a lot of people, myself included, didn't appreciate is how much of that hot money hedge fund trend following, I don't really give a stuff about gold, it's just a trade type money, was in the gold space. And we've seen that money flow out now, and it must have been $400 or $500 worth in the price. So yes, I think at some point that will reverse us. I don't think the world has solved its problems, and I think the reality will intrude upon that at some point. I just would be very cautious when that money starts to flow back in. Gold bugs probably need to be aware that, well, look, it flew into it last time up to pushed it up to $1,900. But look how it flowed out and how much damage that did. And so when it comes back in, we've got to say, well, is this price move up long-term committed holders, or is this, again, just hot money that's coming in? And we need to be aware of that and think about that factor. And to determine that, you've got to look at what the narrative is going on in the mainstream markets, what hedge funds are saying, and what the chatter is, and to work out whether they're really in that trade and whether it's legitimate money that's flowing in that's going to stay in, or whether it's just hot money. So I think we've got to be careful on the next run up to understand that there's some bubbly hot money in that market, and not to get overly excited about it. I suppose, and be a bit cautious.
The new bail-in laws, of course, have an impact in this, because they will raise the possibility of flow towards gold from other money assets. But I noticed that whenever I read the IMF bulletins or papers about bail-in laws, they keep using the word, if investors see it's only going to happen once, they won't react. They emphasize this again. The two things they emphasize is, A, investors should not have time to get prepared, and B, it must be made very clear it will never happen again.
Look, the bulletins I find getting quite excited about it, but the reality is that as a depositor to a bank, you're unsecured creditor anyway. And I think all the bail-ins are doing is really formalising that and making it probably a lot easier to affect what really would happen if the bank actually went bankrupt. So they don't want the banks to go bankrupt, because in a bankruptcy you're still going to get bailed in. You're still going to lose a percentage of your deposit. It's just that the bail-in laws are more about saying, well, that's the reality. As a depositor, you're unsecured and you're going to take a haircut. But we don't want to go through the whole trouble of having the bank go actually through bankruptcy. So let's just take your haircut off you and let the bank continue going. So in substance, I don't actually see any real change. In some sense, that it should highlight to anyone that's got half a brain and is aware that, you know, you are now definitely clearly an unsecured creditor, and, you know, the governments do not have the capacity to come in and just make you whole and let everyone else wear it, which is what I suppose a lot of people do, you know, think that, you know, the governments will somehow not let the average person in the street take a hit. So the bail-in laws are interesting. I think that, look, people are sheeple. There's a lot of sheeple out there, and they don't really understand it, and they think that the government's looking after them, and, you know, okay, yes, I'll, for the good of the nation, blah, blah, blah. A lot of people think like that, so I think it's possible that they can get away with it. I think people that are a little bit more critical, and gold investors, I think, a bit more aware of that, are probably a little bit smarter, but they're in the minority. But for gold investors, you know, you've got to make sure that you're not in a bank yourself, because you'll still get bailed in with your gold. So there's no point going to the safety of gold and then holding it within a bank and getting caught up in that process potentially. So you've got to hold the metal out in a non-bank situation with a custodian who isn't a bank, really. Or in your hands yourself, personally. So
I think you can divide people into two groups: the ones who react in advance and the ones who get hit.
Well, I think unfortunately that's the reality. You know, and but having said that, I mean, in 2008, when there was a lot of fear about, you know, the solvency of the banks, I mean, in Australia, we did basically, there was a book that came out about it. We really effectively was having the beginning of a bank run. And even at the Mint, I mean, we had it's an anecdotal story of a lady who went to her branch and took out $150,000 in cash and walked it over, you know, to the Perth Mint to buy gold. That's how paranoid and scary she was. And I think that was replicated in many places, and that's why, in this case in Australia, the government stepped in and said, we'll guarantee, because they knew that they didn't have an explicit government guarantee for the depositors. So they knew that they had a live bank run in that situation. So it is possible that this could unravel also quite quickly. I mean, I think each country's probably got a different level of sheepleness in the population, you know. So it'll be a dynamic situation, but we saw it in 2008. I wouldn't underestimate potential for a bank run scenario. But, you know, if they're going to bail in, they'd have to do it on the quiet. But I don't know. I mean, I'm just not sure how that will play out, to be honest.
Well, they're only going to do it once, and they swear, and it'll never happen again, and you're absolutely okay, and it was to save the country, eh? Well, Bron, I think I should just say we've gone over time, and I certainly very much appreciate everything you've done, and your input. It's much appreciated, and thank you very much. Ladies and gentlemen, Bron Suchecki from the Perth Mint. Thank you.